Hello, everyone. Thank you for joining the KraneShares webinar today. My name is Derek Ian, Senior Investment Strategist with KraneShares. Join me today, we have two AI experts from Atton Capital, Max Chen and Solomon Beer. We're going to have a discussion on how to invest in AI and investment opportunities, both in the private and public space. So for investors who need CIMA and CFP credits, please email us at ce@kraneshare.com. And for any questions like during the webinar, you can submit your question to info@kraneshare.com if you join via the website. If you join via the Zoom, please just ask your question in the Q&A box. So let's get started. For investors who don't know KraneShares, we are a New York-based asset manager, managed about $13 billion. We are founded by our founder, Jonathan Crane, back in 2013. Our mission is to really provide our investors very innovative, high conviction investment vehicles to really get into some market that's really hard to get access. So you can see along the years, we have launched many investment solutions across the China, climate, alternatives, and emerging markets and global emerging technologies as well. So about 2 years ago, we have this idea to really launch an investment solution for the investor to tap into the probably most important investment opportunity and structural growth in the long run, which is AI. So through our partnership with Atton Capital, we talked about how to create a benchmark for AI. And we realized there's some challenges for that. One is this is very dynamic, just like what happened to internet. There's some opportunities, but there's some hype. So how can investors really identify the AI winners in the long run is very critical to have a dedicated AI exposure. Then we realized another challenge is a lot of critical companies actually in the private space, especially the foundational model companies. So that's why we created AGIX over a year ago. That is one of the first ETF to invest both in the public and private AI companies. And through our partnership with AI native researchers, we incorporate those insights from the AI researchers to a score that power the selection of the public equity portfolio. So, I mean, I don't need to spend a lot of time to talk about the current wave of the AI opportunity. But I do want to emphasize that this wave of technology breakthrough in AI is much bigger compared to all the previous rounds because it's actually based on the foundation of all the previous infrastructure and build out. So that's why we believe this is going to be a very long-term dedicated core allocation in investors' portfolio, and going to drive a lot of growth across active returns. Just look at this year. I mean, S&P was up low double digit, then AI was driving 70% of return. If you just remove all the AI companies from the S&P, you're probably going to have a flat performance. We're going to continue to see that, just like what we have seen in the previous technology breakthrough. You have those infrastructure company or cloud and SaaS company that was driving the active return over 5 to 10 years, and we're going to see that continue. So how to really tap into the opportunity? As I said, for this wave of technology breakthrough, the most important companies, a lot of value creation is actually happening in the private space. So that's why it's important to really get access to those companies. So for AGIX, we use a hybrid approach compared to many, I think, other vehicles available for investors, because we believe a very liquid solution is actually helpful for investors that can get access, because not a lot of private equity and venture capital vehicle or interval fund, they have a minimum investment requirement, or there's like a lockup period, like long, like for the 10 years for some funds. Then for interval funds, like a lot of redemptions gated, so you can only get the money back at like 5%. So we believe a very liquid approach for investors can be very helpful. Then we build a portfolio that's adding to Anthropic and XAI. Currently, we are the direct shareholder of Anthropic and XAI. We see it on the cap table, so it's very different from many other ETF using the SPV approach. We believe direct access is very transparent and the most common way actually to invest in the private space. So the ETF is actually designed with daily liquidity. So we have a daily fair value committee to provide a daily NAV, the net asset value, so that investors can really trade around NAV to provide that actually intraday liquidity for the ETF. So as I said, the AI opportunity now become very dynamic. Like if you look at this year, even within the Mag 7, right? Like there's like AI winners and some laggers, like from the Mag 7. Obviously, like Meta and Nvidia's leading, while like company like Apple is actually not performing that well. We think like investment in AI, the opportunities is actually beyond Mag 7. You can see the opportunities can be from like hardware to infrastructure to model company themselves, and also the application companies. But just like, as I said, the winners and losers can be very dynamic. So you need a framework to really incorporate insight from the AI experts, the AI native investors. So that's why we created at AGIX using a process-driven methodology that we started with a universe of few thousand companies, narrow down to more relevant industries. Then we use that AI score to really pick the top AI ready and AI relevant companies into the final portfolio. We weighted the portfolio according to the AI score and also their free flow market cap and rebalanced quarterly. So we believe this process is very good long-term solution for investor to navigate this dynamic of AI uncertainty. Even though a lot of companies gonna be long-term AI winners, but we do think along the time, a lot of company can be just a hype, or even like their business model gonna be disrupted by AI. So simply invest in technology or simply investing the broad like Nasdaq or broad market is not really good enough for a long-term AI solution. So as I said, just like what happened to internet, there'll be value migration across the three stack, the hardware, the infrastructure, and applications. And our allocation to those three layers actually also dynamic, reflecting the latest view from the AI researchers. So I think when we just launched AGIX, a lot of like the weight actually is allocating to the AI hardware. But now as the inference is now booming, a lot of token consumptions, a lot of computing is happening in the infrastructure there. The weight is now more towards the AI infrastructure side. And we have seen that it's actually benefiting the investments since our inception. So a lot of questions we got actually is like how this AGIX is different from many existing investment product, including the broad benchmark. So we did analysis to look at what companies we hold in AGIX are not actually included in the Nasdaq index, Nasdaq 100 index. So we found about half of the portfolio weight is actually outside of Nasdaq. And those companies, part of those are private, right? Anthropic, XAI, and some are public, but like that's really under-owned by many investors globally. So you can see here's the top 10 holdings that in AGIX are not in the Nasdaq 100 that we own. So we want like create a really differentiated solution to really create like impactful portfolio impact to the investors. So when you look at the performance, you can see this framework actually worked since the inception. Since we launched AGIX in July 2024, we have delivered a 47% total return compared to Nasdaq 100 about like 26, the technology sector about 27, S&P about like 19.7. The semiconductor index actually the worst performance is like 18%. And we achieved this performance on actually a very good risk-adjusted basis. So if you just look at the volatility, actually we're not adding much volatility compared to, say, semiconductors. But then you look at the risk-reward, actually the AGIX is offer a better risk-reward compared to many technology and broad market benchmark. So that's a quick overview of the fund. I think some investors know about the fund. So for any question about the vehicle, you can please submit your question to the Q&A box or send email at info@KraneShares.com. And just like give a quick overview, currently we manage about like 90 to 100 million in the fund with like 50 companies in the portfolio. Total expense ratio is 99 bips, and is listed on Nasdaq exchange. So anyone with the brokerage account can actually just trade it. So as I said, like if you look at top 10, you have some like similar name, familiar names, but the weighting is very different compared to the broad benchmark. And we have many companies that's not actually in the Nasdaq benchmark. So that's the portfolio, and we believe the AGIX can actually be the AI benchmark with our public and with our private. It's kind of like a long-term solution for investors who want to capture this structural growth in AI. So with that, I'm gonna start the panel discussion with our guests today, Solomon Beer and Max Chen. So maybe Max and Sol, maybe just before the conversation, do you want to maybe give you a little bit your background to our audience today? Max?
Yeah, sure. Sure. Thanks, Derek, for having us. So I'm Max Chen. I used to work, in Sequoia, and then started Anthropic Capital like 3-4 years ago. Our mission is to provide the most cutting edge technology exposure to our investors. So we luckily focus on ourselves in AI. We were one of the earlier investors in all those foundation model companies, and over time all those companies have experienced tremendous growth. And while we are investing in the private sector, we are thinking about what's the best way to capture this AI wave. We have noticed that a lot of the values have been captured and accrued in those public companies. So that's why we come up with the idea that to create a vehicle, the AGIX, to provide investors with a holistic exposure of the AI names, both in the private and public sector. So yeah, that's my background.
Thanks, Max. My name's Saul Beer. I'm one of the portfolio managers at NA. Previously, I was one of the early engineers at Cruise Automation, one of the self-driving car startups that sold to General Motors. So I've been working on AI and things around AI since 2013 when AlexNet was released, and we realized you could use NVIDIA GPUs for machine learning training. And a lot has changed over the last decade.
Yeah, I mean, like so you're like and both engineer, you have many patents in AI machine learning, right? So I mean, like you've been in the industry forever. Like many people now compare the current wave of AI to the kind of like early internet era. Do you see that like there's some like similarity there? Like, do you see anything different for this time?
Yeah, I think there's some similarities both on the negative and the positive. The negatives being some of them around tripping, and part of that is just because the cost for the infrastructure build out is so large. that a lot of the debt provider, they need some level of confidence. So you end up in these weird, funky arrangements. But I think what's different than from the dot-com boom is that a lot of this stuff is being disclosed. So Sarbanes-Oxley was passed in the 2000s, and as well as a lot of it is being tied to funding contingencies around revenue and revenue growth, especially for OpenAI around Oracle and other companies. The other areas that we're seeing differences is just the level of monetization and adoption at such a fast pace. I think in the dot-com era in the 2000s, the internet was so new, but the infrastructure was barely there. Right now, a lot of people have smartphones, they have high-speed internet connectivity, so the ability to adopt new AI technologies is a lot easier, which is why we're seeing companies get the startups in the ecosystem get the 100 million in revenue a lot faster than we've traditionally seen in SaaS and the mobile boom previously. So there's some worry about the infrastructure build out, which is somewhat inevitable given the amount of whenever you have a new paradigm shift, like overnight, you need to build out a lot of capital intensive fields like data centers or building out fabs for chips. But in terms of monetization and customer usage, I think it's actually a lot stronger than we saw in the dot-com era, which is mainly driven valuations by clicks and page visits, not revenue.
Yeah, I totally agree. I mean, like we have the infrastructure, then you have real customers and earnings. So Max, like anything you want to add? Because like I mean, like many investors probably worry about like the valuations now getting a little bit high, and just reminds people of the dot-com bubble, right? Like, so how do you really compare that?
Yeah, I think it's very interesting that we have seen the deals like, between NVIDIA, OpenAI, Oracle, AMD yesterday. I think it's a very different story from the dot-com bubble because dot-com bubble, like Saul had mentioned, is totally driven by narratives. And but this time, all those revenue are driven by, or those valuation are driven by cash generating infrastructure buildouts. I think deals made between OpenAI, NVIDIA, and all those guys is a way to solve the total demand for serving billions of users with the power and capacity from all stakeholders or parties. So I think in our view, it's a way to align the incentive and accelerate build-outs. So it's very different from the 2000 banner ads or portal traffic swaps and double counting. So I think that's one difference. And if we look closely at dot-com bubble, there's some analogy that can be drawn from a company called Lucent Technologies and their kind of vendor financing practices. People fear that same story will happen again to NVIDIA and OpenAI. But I think the difference is, back then, like Sol said, nothing runs online. People were dreaming about streaming, which actually happens years away. But back then, everyone is building the infrastructure with the assumption that the demand will double every year to infinity, right? So, but right now, literally everything runs online, and AI will penetrate all the workflows that we have. For example, for professional life, all businesses will be automated or augmented by AI. And for personal life, it's like life choices will never be easier now as AI will empower our decision-making processes. So I think we have the real demand this time, and to some extent avoid to be filled with all those AI capabilities. So I think it's very different from the dot-com bubble. But yeah, I think we need to be careful on dreaming the future, especially considering the price per token drops a lot, tremendously during the past 2-3 years, and it may surpass the demand increase, has lowered the total revenue generated by those smaller companies. And there are another possibility that the scale all might plateau. Psychologically, people will just think this AI wave is just another technology that's no difference than electricity because people are so used to it, right? It's not a digital god that we can cure cancer or invent new materials. But then, then we might have an air pocket. But I think we are still far, far away from that. Given according to JP Morgan survey, we are only penetrating like less than 10% of the workflows in the enterprise world. Even with the AI model that we have now, there are a lot for us to grab down the road, I think.
Totally. I mean, like, look at just the internet. Like, I mean, the cost of the data in the internet era like went down like 1,000 times, right? Like, we're gonna see like probably similar cost decrease for the tokens inference side. But like still like the demand is gonna be like even higher. But like this dynamic can be very critical, right? So just like like do you see any other on the demand side, do you see what's the like fast growing area you see in like also like in terms of monetization, which is the kind of like the best low hanging fruits right now, like or like it's upcoming, you think?
Yeah, I think for right now, the initial areas of traction was in consumer. So ChatGPT and companies like Perplexity and others were mainly focused on direct to consumer, uh, having customers maybe interact with the chatbot. We're starting to see companies like Anthropic who are selling their API business or even XAI starting to slowly get adoptions. I wouldn't say enterprises, it's more larger tech companies like a Coinbase who have the technical capabilities to start automating a lot of their workflow, or companies like Klarna who I mentioned that as well. And that's going to be the real driver of revenue for a lot of these businesses or for a lot of these AI companies, because for a lot of these larger enterprise businesses, the majority of their cost is driven in SG&A, right? Employee costs over 30%, 40% for typical S&P 500 companies driven by labor and personnel. So the value proposition is different, right? And I think when we talk to OpenAI and Anthropic, the big regret from a lot of them is that we underpriced our model and we're running out of inference constantly. And some of our enterprise customers have a higher willingness to pay. They're less focused necessarily on optimizing the lowest price per token, but more focused on can we get as much inference and compute as possible so we can, because the trade-off in using physical or actually human workers, it's a big trade-off. So we're really excited about the monetization, and we're also seeing tons of disruption in public stock as well in terms of winners and losers as well.
Yeah, totally. I mean, like we do see like Anthropic, like the valuations like tripled almost this year, right? AGIX investing Anthropic, I think March this year at a valuation about 61.5 billion. The latest round is now anchored at 183 billion. So Max, like how do you think about like what's driving this like change, right? Like why is Anthropic suddenly like have a surge this year?
Yeah, I think if we look at all those differences among model companies, you can see OpenAI is focusing a lot on how to create an AI OS layer or kind of an AI operating system for the consumers. So that's why they put a lot of resources in the prosumer market, giving out ChatGPT and all those video image generation capabilities to the average users, and hopefully they could also create some kind of hardware that allow people to interact with AI. Like I said, as a normal human being, you probably made over 3,000 or even more decisions every day. Imagine all those decision-making process can be empowered by AI. There are huge demand that needs to be filled. So that's why the bottleneck for OpenAI right now is really the compute. So that's why they are so aggressively, signing all those contracts and trying to lock in all those resources, no matter it's a data center, it's electricity, or it's GPU chips. So I think that's the strategy for OpenAI. And for Anthropic, I think they put a lot of emphasis on enterprise market because they believe that as a model company, the mission is really to drive productivity boost, right? So that's why they kind of offer their API to a lot of the enterprise customers. And one key feature or key capability that they delivered ahead of everybody else is coding capabilities, right? So if you imagine that the model can actually code, it gives the model the capability to change the workflow to create software and to actually do things and finish tasks, and also all the tool use capabilities that Anthropic delivers is really the state of art capabilities that all the model companies, all the other model companies are currently trying to achieve. Right. So with that capability, I think they really unlock the use cases for AI coding. which you have already seen the explosion of usage on those tokens in either it's a startup or it's a big enterprise. I think everyone is trying to use Anthropic model to code, to create software, and to automate workflows. So I think that's the secret source for Anthropic that have been experiencing tremendously strong growth this year. And down the road, I still believe that Anthropic will keep delivering and delivering the SOTA model capabilities in this direction. I think the next stage would be Anthropic will be more and more customized for different enterprise use cases. So that's why if you look at the news, they are recruiting like 2,000 people. Paradoxically, I think right now the bottleneck is really human labor, right? So they need a lot of engineers, full deployment engineers to be deployed to all those different Fortune 500 companies, and actually, through reimagining their workflows to actually boost their top line and bottom line numbers. So I think that's the next stage for Anthropic.
Yeah, I recently read a survey which industry is actually deploying AI. What's the subscription percentage for each industry? So technology industry is actually leading far from other any industries. I think 72% of technology companies are using AI. Just anchored to what you said, AI coding is probably the most important tool right now, right, to really monetize. And given Anthropic leading edge in that front. So I want to ask then, so how do you think about XAI, right? So now we have OpenAI is really good at consumer side and Anthropic coming to this enterprise side. How do you see XAI going to compete going forward?
Yeah, I would not count Elon out. So there's two areas that they're competing. First, Elon owns X, which is a great distribution platform. So probably the only company that can compete with OpenAI on consumer-faced AI. Its second thing is they're building out their data centers themselves. So OpenAI and Anthropic depend on AWS and Oracle now, and to some degree, in Microsoft previously for OpenAI. XAI is kind of making a big bet on owning the entire cloud and GPU cloud infrastructure. So he's building a huge facility in Memphis, which potentially could be an unlock if new compute is needed for the next breakthrough in model capabilities. They've been focusing a lot on reinforcement learning for coding as well. So we expect there to be some competition with Anthropic, and from our perspective, the market will consolidate probably between these three main winners, and in the same way the cloud infrastructure as a service market looked in the 2010s.
Yeah, I mean, I think both the OpenAI, Anthropic side, growing tremendously in the private market, especially this year, right? You have to see valuation pop for many names. How do you see the value creation dynamic between public and private, right? Do you see private gonna cap valuation on the public side, I mean, it's rising, then you have seen this year private is going up. How do you see this dynamic going forward in terms of valuation?
Yeah, that's a great question. I think there's a lot of assumptions that most of the value will be created in the private, and people question why should we even own a special ETF or a sector-focused ETF. We kind of question that. If you look at a lot of the category winners in the stock market for the past 12 months, I think this year to date, the AI-focused companies like NVIDIA is generating about a third to a fourth, actually a little bit above a third of the gains in the S&P 500 and Nasdaq. We're also seeing a lot of realignment. So if you want to own the general tech ETF, you're not necessarily getting the boost from the AI sector. So an example would be SK Hynix, which is a Korean company. They make the HBM, which is the memory for a lot of the NVIDIA GPUs. And historically, those memory chips, those were very low margin businesses, them and Samsung and Micron. So if you own the Nasdaq, you'd have some percentage exposure to maybe some sectors like this via Micron, or a global tech index that would have Samsung. But because the AI market is moving so rapidly, all of a sudden SK Hynix, which is a Korean company that owns this memory chip, all of a sudden is printing money and the stock is up considerably. So we think a lot of the revenue will be generated or valuation will be driven not just in the privates, which we have exposure to, but also in making sure that you are indexing the technology to be focused on areas that have tailwinds from the AI sector. That's especially true for utilities and computing. So we've had Nebius as an example, and Nebius also owns a decent portion of ClickHouse, which is a private OLAP database, which is getting a lot of tailwinds from the AI sector. And those two things together is what's going to drive a lot of the performance for the ETF.
Yeah, totally makes sense. I mean, like, there's opportunity both in public and private. So investors shouldn't be like just liquidity. It should be like liquidity agnostic, right? Take a more broad approach to tap into opportunity where it is, right? So, Matt, I mean, like we touched a little bit about this like stack or like layers migration, where values migrating from hardware to infrastructure and application side. But I remember we had this conversation. This is very dynamic and mostly driven by the model intelligence. Can you maybe share a little bit more about that idea and how should investor really understand that?
Yeah, I think right now we are still early in the AI kind of evolution. So that's why you see, the pace of change in the AI, especially the model space, is quite fast, right? So every week you can see the new release of the open source models, closed source models, new versions of models in different like video generation, voice generation, a lot of models being released every week, right? So right now, if you can summarize this into one sentence, is model is a product, right? So that's why you can see a lot of value being accrued by those model companies, and that is why there's a saying in the private market that OpenAI is going to eat a lot of the space of other startups companies, because the model kind of overwhelm other services that provided by the other startups. I think on the public side, things might be a little bit different because for public companies, you in order to win, you need to have several things in your hand. One is you need to be very AI native. It means that you need to reimagine your business from product level to kind of a dog footing, meaning that you need to use AI to improve your businesses, right? So it's kind of a compounding advantage through three factors, I would say. One is a learning loop. The second is distribution, and the third is unit economics in order to win, right? So for learning loop, I actually means the company constantly collects all the detailed user interaction data, and what has really happened when their customer is interacting with their AI system or with their product, and then they can use this feedbacks collected and aligned to kind of create the reward signals or ground truth labels, right? And then rather than kind of waiting for a mega release, the company can just iterate their model updates so that they can refine the model iteratively on the most freshest possible user aligned data, and then redeploy their product to close the loop. So I think it is even a more powerful flywheel compared with the data flywheel or network effect that we have seen in the mobile internet age, right? So I think that kind of flywheel is I think a lot of the incumbent companies is actually having an advantage over startups, given the resources, the embedding of their workflow, their product in the workflow of their customers, all those advantages. I think the incumbents enjoys, right? And the second is distribution. I think it's like a very very classic Microsoft Teams versus Zoom story, right? So you see everybody is using Zoom, and the people claim that Zoom is a better product, but actually Microsoft Teams wins because their distribution capabilities. So you need to have large installed base user bases and channels, and sometimes those advantages beats a better model in isolation. Let's put it this way. I think the third is really about unit economics, because at the end of the day, it is a competition on cost per token, right? So especially when model is commoditized, which it will eventually be, right? So the ability to reduce the inference cost per token, enabling rising margin and faster latency, relies on the capability that those companies regardless if you are a model company or an application company to kind of optimize your cost from an end-to-end fashion. So that's why we are very bullish on Google because they own the whole tech stack from chips to data centers to models that can optimize in an end-to-end fashion. So that's my view on the competition between the startups and the incumbents, and what are the advantage and disadvantages.
Yeah, makes sense. I mean, this is going to be a very long-term structural growth. And I think compared to remember internet, you have AOL, you have Yahoo, right? Who's their business totally now is different. How do you see that? If you compare to the kind of internet era, who's going to be the AOL, Yahoo now? And how do let me ask you in a different way. Which company can be the winner in the long run with very sustainable mode, right? And which company can potentially be disrupted? I don't know. So you want to chime in?
Yeah, it's definitely a little early in the market to say. I think right now, NVIDIA probably has a pretty strong moat right now in terms of their CUDA and how widely adopted the CUDA kernels are in GPU training. If there's a change in architecture and there's no longer a need for maybe a general processing unit, that can potentially be disrupted down to the application layer. If you look at companies like Google, if these AI models get so good and other companies are able to get access to Google search data, and you're searching less on Google potentially, right? Google's business model might evolve as well. And then in terms of legacy companies, we've seen companies like tutoring companies like Chegg, or companies that have seen pretty significant drops in the stock market. And I think the last thing would be traditional industries that are relying on that are not AI native, that are like consulting firms, maybe like at McKinsey or others, where maybe people can do that in-house if you do that cheaper. So there's a lot of potential, both winners and losers in the segment. In terms of AOL, the early winner that stumbles, I think that's pretty early to say right now. It could be any of the companies that we had mentioned before.
Yeah, I mean, it could be definitely company that's just become a hype, right? And let's talk about SaaS a little bit. I think Max, you mentioned it, the cost of tokens is going to be an advantage. How do you think about now a lot of SaaS company, how they everybody's going to use AI? I think previously we have a boom because their efficiencies, right? Lower cost, better margins, but how can some company really transform their business? Do you see AI, what's the potential for a lot of SaaS companies going forward to really shifting gears?
Yeah, I think SaaS company is a heavily discussed or debated area. It's really hard to tell. That's why a lot of the valuation is kind of compressed, given the pressure by the model companies, because people are saying with more and more or stronger and stronger coding capabilities, the traditional software industry will become like a fast fashion industry that you whenever you want to use some software, you just summon the coding agent to code one software for you to use, and then you just toss it away. So that's why a lot of people are so bearish on the traditional software companies. But I think it's if you think deeper on this, I think it really depends on the execution capabilities of all those software companies, right? So like I said, in order to win, you need to have the learning loop. Learning loop means that traditionally software are very static. You can't change much. But in the future, you can have a hyper personalized software, given the model capabilities that you have. Probably the Adobe, Photoshop software that you use and the software that I use is totally different, right? So it depends on what kind of capabilities I want, what the workflows that I enjoy, but probably you don't, right? So it's gonna be very hyper personalized or customized experiences for everyone. But at the bottom of those hyper personalization, the infrastructure is not easily done by coding agents, right? So you can't trust the coding agents to build the infrastructure for a very sophisticated software like Microsoft, Office or Adobe. So that really depends on if the software companies can transform their, so-called dead software into a living software, so that they can iterate very fast based on the interaction data that they collected through the user interaction, and then learn from the deployment. So I think that in order to close the loop, they will gain a huge advantage over the startups, right? So that's one possibility that we may have. And the second possibility is that the software is becoming like forkable. To put it this way, you see Sora being released last week and created a lot of hype. And the best feature in Sora, in my opinion, is the capability to fork, right? So if you come across a video and then instead of swiping up and down, you can swipe left to right, and then you could see the different version created by AI based on the same kind of a prototype or same video. You can actually fork it. So I think that applies to software as well. So if the coding capabilities really becoming more and more advanced, you can actually fork your own version of the software and unleash a lot of creativity based on the existing a solid foundation of the software. So I think that's another opportunity for a lot of software companies. But at the end of the day, it's a combination on execution capabilities, right? So you are basically competing with a lot of startups out there. The startups may attack you from different angle. Like if you are Salesforce, you have CloudForce, you have customer for you have different kind of services. You are selling your customer service agents, you are selling your sales agents, but a startup may be very focused on attacking one specific feature that you are offering. So how can you actually leverage your distribution capabilities and also your resources to create a kind of a holistic solution for a lot of the enterprises that already embed your traditional software into their workflows? I think that's the key of the competition down the road.
Gotcha. I think previously it's data flying wheel. Now is kind of like token environment and learning, right? Reinforcement learning, flying wheel. So thanks for that sharing. I mean, like Saul, so Max, you've been building this private deal pipeline for AGIX, right? So maybe can you share a little bit like your thinking, like what areas like maybe investor haven't really looked at, like that's really offering some unique opportunity. So do you want to start?
Yes. I think the point of the private sector exposure is that it gets you access to companies maybe earlier in their life cycle, where a lot of the value accrual has traditionally not gone to public market investors, as you mentioned before, Derek. Maybe there's high lockups and you need to invest in a fund, a private venture fund. Historically, or at least over the last year, we focused mainly on the model companies, Anthropic, XAI. You may see one or two other model companies added soon. I'm sure you can infer which of those potentially those could be. But moving forward, we're going to start moving further down the stack. As the industry starts to mature, we will add companies that are either in the application layer or doing things like drug discovery or defense, so that the breadth of the private market exposure will broaden. And that was really done pretty thoughtfully. Is that our expectation was at the beginning, you focus on the companies that are really the most horizontal, the companies like the Anthropics and XAIs of the world, and then you move down market as to companies that are supported by the infrastructure build out in the private markets.
Yeah, that's exciting. Like, I mean, every investor is waiting for that. I mean, we have covered a lot. There's a lot of questions, I think, submitting. So just want to remind everyone, like, if you join via the website, you can submit your questions to info@KraneShares.com. And if you're joined through the Zoom, please submit your question in the Q&A box. So we do have some questions like from investors. The first one is for me, actually, how do you manage the private exposure when there are fund inflows? So I think like this is a very good question. Just ETF generally is a 40-Act fund, so we deal with daily inflow and outflow. So the private investment, you can see that's like investing some, for them like a real asset, right? It's like we have shares, then there's a fair value on that shares. So every time there's like fund inflow, the exposure going to be diluted. Then when there's outflow, then the weight of the private going to be higher. So it's going to be very dynamic. But as I said, through our partnership with Aetna, we have a strong pipeline of private companies that we have engaged over the long time. So we're going to keep adding more AI private exposure to the ETF as the fund grows. So then the next question, I think, what is the Aetna's role in AGIX? So Aetna Capital is a sub-advisor for AGIX ETF. It's a sub-advisor for KraneShares as well. So Aetna, I think on the private side, they're the portfolio manager. They actively manage the private exposure within the AGIX. And for the public exposure, they provide the AI native scores to really support the framework we described to select the portfolio in the public space. So let's look at this question from Simon. So how do you value private equity holdings since they don't trade openly? So at KraneShares, we have an independent fair value committee. So every day we're going to have a fair value meeting to really evaluate those private holdings to assign a fair value. The fair value is going to be based on many factors, including the primary round valuation. And between the primary round valuation, we're going to monitor the secondary market transactions. Those data is going to be very valuable for us to really determine the fair value for our investors in AGIX ETF. So people can actually trade ETF with the fair net asset value. So that's the question that's the answer for Simon. Then we have this question. So current PE of AGIX. Can you comment this in light of the non-private holdings? So what is the the PE? So we can actually send a follow-up to the investors, but I think that's tied to our discussion on the valuation of AI. So I don't know, Saul or Bill, Saul and Max, how do you think the valuations, I think currently compared to historical average, the PE ratio is high. Just overall, Nasdaq is at a high PE ratio, right? But if you look at PE ratio on the internet booming era, you do have a much higher. Definitely, the dot-com bubble is much higher. It's around 60 to 70, crazy numbers. But then the PE ratio over the internet boom is actually quite high as well. But you don't get that crash until dot-com bubble, right? You do have the growth, the earning growth is growing faster to really bring the 4P down on the years. So how do you see that the company is going to deliver those earning growth going forward? Max or Saul, you wanna chime in?
Yeah, so the PE ratio changes a lot. So I can't give you the exact quote today. I think it was sub 30, 28 for Nasdaq. But the important thing is the forward multiple, and it's really driven by forward growth. If you look at Nvidia, they're doing over 80% year CAGR growth in terms of revenue for a company at 40 to 60 billion. For the data center business, it's huge, right? So that's really what's driving the elevated PE. So I don't think you could just look at last 12 months PE and say it's elevated. It doesn't really tell you much. And Derek, as you're saying, compared to .com, it's expensive, but compared to .com, it's not out of whack, or it's not something that's really in ridiculous bubble territory. But I would definitely overlay that with the next 12-month growth or 2-year growth and factor in the growth rates for some of these companies. If you were trying to look at a valuation, and I wouldn't necessarily try to be too conservative with comparing it to a general industry where the growth rates are a little bit more mature and slower.
Yeah, I totally agree. I think growth is the key here. If you look at, in a more abstract way, what AI can actually do is, to boost productivity, right? So not only in the infrastructure sector that you are witnessing the data center build outs massively, that can drive 80, even 100% growth rate for a lot of stocks that are in AGIX. But if you look at the software sector and also the cloud businesses, I think they are also generating a lot of the growth, given they are, the word that I used before, dog fooding, that they are using a lot of the AI agents to actually increase their productivity. Like, Jensen Huang have mentioned that in a podcast saying, what they think about AI and how they are going to use AI in their kind of the own use cases. It actually, can empower a lot of the engineers that they have. Like imagine one engineer right now have five helpers, five co-pilots, and then you could assume that the workforce in all those software companies in all those companies like 5x or even 10x. Then the productivity and the growth because of that is really gonna transform or ease the concern for a lot of valuation at the moment on the market.
Great. Yeah. We have another question asking just like how do we get access to the private companies? Like I think we participated in the Series E round of Anthropic March and tender offer round of XAI this July. But like generally like speaking, like Max and so like how does AGIX invest in those like companies directly, like as a like mechanism?
Max, I mean, we wire the money to the companies, and the rest happens. Is the simple answer, and they generally we're pretty well connected, and this team has been worked in the AI industry for a while, so we have some connectivity in the AI ecosystem and are in that network, and then we'll really evaluate each company on a case by case basis, both the company and also the round, the financing and valuation. And then KraneShares itself and its custodian kind of handles more of the back office and share registration. I don't know, Max, you want to add to that?
Yeah, I think it's a collective effort, right? So, and working together with KraneShares and given our, the AUM of the two platforms, and we can provide a lot of value for all those companies. I think for a lot of those companies, especially startups, I think you can in one way call them startups. Another way that they are really close to, potential IPO. So they care about the public participants participation in their, funding. I think that's the edge that AGIX as a ETF, as a public ETF, can have access to all those private assets.
Yeah, yeah, like it's been a great time working with the Atom team. So then the next question is like, how do we obtain the valuation data from the secondary market for shares of Anthropic and XAI? So actually, we partner with some third-party data vendors, one company called PM Insights, one of our major data vendor to really getting access to the secondary secondary market transaction data on the private companies. So we rely on some of those platforms, those data vendors to really have a more transparent data on the transactions and bid and ask and on the level of where those private shares are traded. So that's a very important input to our fair value committee. So I think the next question is on XAI. So investors asking, XAI is starting an AI gaming business. What is the latest on that? I don't know, Saul or Max, you know that?
Well, that's the first I've heard. That we I don't know if we can comment too much on product releases that haven't happened yet. There has been some rumors for XAI. I don't know, Max, is it public yet? Their
Yeah, I
gaming
think
efforts.
Yeah, I think there are some news that they recruit a gaming team to develop the game
Mhm.
empowered by AI. I think we can only discuss in a very abstract way. I think in general our investment thesis around AI actually it plays at in four phases. The first phase is the AI for productivity. That's why you see a lot of the coding apps booming and a lot of the PPT generation apps that are showing up. And the second phase would be, gaming as training because we believe that, the language data is not good enough for, for us to train the so-called AGI. Because think about it, if you can only put all those finished data, if you write a report, then you can only put the finished product into the training data set, then it kind of lacks the process data, right? So how you iterate the paragraph, how you think, how you structure the essay. I think that kind of data is missing for training. I think in kind of a gaming setup, you literally created an environment that can collect all those interactions between the user, player, and also the agents. I think all those data will be tremendously valuable for us to to reach the next stage of model training. And the third phase will be companionship, and the final phase will be robotics. So I think that's basically our philosophy. I think it rhymes with Elon probably because Elon constantly saying that the real world is the final reward, and the real data that embed your AI product, embed your AI agents in a real interaction with human beings. That's the most valuable way for you to collect all those data. I think that's probably the purpose of him to launch a gaming in XAI.
Yeah. So I think next question is, how is AGIX different from other AI ETF? So I can answer a little bit. I mean, like first, we partner with AI native researcher to really incorporate the AI score into the index to select the public equity, right? Then we have private. That's obvious, the difference. But I want to say that when we look at like when we launched the AGIX, when we discussed the idea with Max and Sol, we realized most AI ETF, they're either using a traditional index provider to select AI companies using keyword searching or like revenue, like industry classification system. Like that's so challenging to us, like to really acknowledge that is that a good way to read investing AI? So we ask ourselves, if we use like first principle, how are we gonna do it? So that's why AGIX is very different because it's AI native, and it's thinking regardless of public and private. So I think like that could be quite different from many existing products in the AI space. I think the next question is when the private companies on the ETF got acquired, like how do we really like hack into that in the valuation? Like I think we have like actually like XAI got like merger with the X, right? Like Max, like how do you see that like those like potentially in the future if the private exposure like or maybe asking generally how to say like potential exit for the private exposure in the fund?
Yeah, I think there are two ways. One is the company is being acquired. Then it depends on what kind of acquisition that you're having, right? So if it is acquired by a public company, then you probably got the public company's shares in as a as a result. And then if the private company becomes IPO, of course you will have all those public shares that are in the ETF, which will unlock a lot of our quota to invest in other private companies down the road. I think that's basically two results that you are going to have if you are talking about the exit potential for all those private shares. And the third way is definitely for us to understand the growth potential for all those private companies. If we identify some private company is not a good fit anymore for our portfolio, we can trade it on a secondary market. So yeah, so that's basically three ways for us to exit.
Sounds good. And for more questions, like from investors, we can follow up with you on the info@KraneShares.com. If you want to request this deck, please feel asked to do follow up with us. So just last question for Saul and Max. What book do you recommend for investors who want to follow up the AI and work? Just generally, what's your favorite book right now?
I really like Chip Wars. It will give you an overview of the buildup of how hard it is to build up supply chains, to give you an idea of how much has gotten into where we are today for the NVIDIA GPUs and what went, and give you some inspiration and what's powering the current boom.
Yeah, I would recommend the beginning of it, Infinity. I think it's more philosophical, but it represents the optimism that we have during this new, technology paradigm shift.
Yeah, it's a great book. Thanks for the recommendation. And for investors who want to know more about AGIX or just generally just want to do some more research on AI, you can visit KraneShares.com/AGIX. We have our pitch book, our fact sheet. We have a white paper. We're gonna update it with the Aetna team coming soon. There's an FAQ about like the private mechanism for AGIX on the website as well. So for any more information, just you can just go to KraneShares.com/AGIX. So thanks everyone for watching the webinar today and joining our discussion. And thanks Max and Saul again for this like wonderful conversation. Just so for any investor who wanna follow find more information about AGIX, please follow our KraneShares website. We're gonna have this webinar soon. Thanks for watching. Bye everyone.